What's up, guys? Nick here. And in today's episode, I'm going to be reviewing another dividend growth ETF. It's called DGRO or DGRO for short. But before I get into that, let's just do a quick overview of my portfolio. So I actually finally surpassed the $50,000 mark, which it took all year, but I'm definitely happy and excited to see that $50,000 in my portfolio. That means I'm 5% of the way to $1 million. And it sounds like I'm really far away, but just the fact that I got to $50,000 tells me that I can get to 1 million, especially with the capital appreciation compounding working in my favor, as well as my dividend income working in my favor, which to go right into that, I'm currently at $2,030 or $2,031.15 in earned dividends for the year, which is exciting. That's 2% of $100,000 in passive income in a year. And my portfolio's down almost $3,100, but my total return is negative 2.22%, which we're going to see how far the S&P 500 is down, and I want to say I'm beating it by almost 7 times the S&P 500, which is pretty cool. One saying I like to talk about is when the stock market is doing great, my portfolio is doing good. When the stock market is doing horrible, my portfolio is doing good. So I would say we're in a time where the stock market's doing horrible. As you can see, only down 2.22%. It's pretty good. Now, moving into the activity feed, I haven't gone over this in quite some time. However, I want to start us off with the 21st. So I put my normal $125 as I do every single Monday. And then I actually had 7 buys and 1 sell. So I ended up selling my MasterCard holding. And mainly that came down to the fact that I just want to get out of single finance stocks. And MasterCard, it has a really low dividend yield, and I just want to focus my money on those higher dividend growth stocks with better starting yields. And as you can see, I bought Apple, Microsoft, SCHD, Hormel, Procter& Gamble, Duke, and American Waterworks. Those are all good companies. Of course, the Microsoft and Apples have lower yields, but still better than MasterCard's, and they have great dividend growth as well. Now, if we move on the 28th, that was a Monday, I deposited $125 and I had 7 buys. And I really like this about M1 Finance, that it buys the stocks that have the lowest weighting. So now we're starting to see that I'm buying more stocks. Whereas before I was buying just SCHD, now it's starting to invest in those other stocks that have low weightings. So I'm really excited about that, especially to see my new dividend income over the upcoming months with these stocks. And hopefully tomorrow and in the upcoming weeks, we'll put less money into SCHD and more into those other holdings. But then I did receive 3 dividends on the 30th, $25.01 from BST, $21.75 from Good, and $7.68 from LTC. And then on December 1st, I received a $5.17 dividend from American Waterworks, and I had 2 buys of Clorox and Hormel. So it looks like right now, Hormel is what my portfolio is buying. So guys, with that being said, let's just get right into the topic of the video, which is DGRO, and it is the iShares Core Dividend Growth ETF. And before I say anything else, I want to point out the tax liabilities for DGRO, since I know that's always something people want to know. And I'm happy to announce that DGRO is or does pay a qualified dividend. That means you will be paying taxes at the lower rates of 0%. I I don't exactly know what that goes up to, 44, 45,000 or something. And then 15% from like 45 or whatever $1,000 and above. And then if you make almost 500 grand, you'll pay 20%. So definitely a good tax. That's great taxes from DGRO to be qualified. So it's currently trading at a price of $52.23. Year to date, it's only down 6.15%, which is great to see. I'm going to show you the S&P 500 in a minute, and you'll see how much more DGRO is outperforming it. And then we have a dividend yield of 2.18%. And let's go into the dividends so I can show you. Yeah, 2.18%, annual payout $1.14, an awesome dividend growth rate of 11.4%. That is fantastic. And then 7 years of dividend growth. So let's swing over to the S&P 500 real quick. And as you can see, it is currently down 14.85%. So DGRO is outperforming the S&P 500 right now by about 2.5 times. So now let's look at the fact sheet. Why would you invest in DGRO? It offers a low-cost exposure to U.S. stocks focused on dividend growth, and the U.S. stocks portion is why we have the qualified dividends. And then it gives you access to companies that have a history of sustained dividend growth and that are broadly diversified across industries. And then, of course, it can act as the core of your portfolio to seek income. And now if we scroll down to some of the key facts, it was launched in 2014. They currently have net assets of $25.1 billion and average daily volume of 1.288 million, which is great to see. That means it is an active fund. And then we have 414 total holdings. And then if we scroll down, we can see their top holdings as of December 2nd are JP Morgan and Chase at 2.96%, Microsoft at 2.78%, Johnson & Johnson at 2.77%, Pfizer at 2.67%, Procter & Gamble at 2.59%, Apple at 2.5%, Merck at 2.39%, Home Depot at 2.34%, Broadcom at 1.93%, and then Coca-Cola at 1.91%. And they are constantly updating these holdings. And something I want to say and point out at this point, so this is a great dividend growth ETF, but if we look at the top holdings, you see a lot of similarities to SCHD. So if I had to choose between SCHD or DGRO, I would personally go towards SCHD because it has a higher starting yield and it has slightly higher dividend growth. But I still think that this is a great ETF to own. And you'll see that later on when we compare it with the portfolio back test. So next, going into the industries, 20.58% is in financials, 19.45% in information technology, 17.2% in healthcare, 13.27% in industrials, 11.26% in consumer staples, 7.64% in discretionary, 4.21% in utilities, 3% in materials. Then we have communication, energy, and then cash. And this actually, the industry breakdown actually does look pretty similar to SCHD. Next, let's do the portfolio back test. So we're starting with $10,000 as our initial investment. We are displaying income, and we have DGRO, the S&P 500, and the QQQ. So I already analyzed the portfolios, and I'm going to scroll down and show you the results. So here, always the QQQ, also known as the NASDAQ, it is always the one that outperforms because it is so tech heavy, but it also has the largest drops. Now, at the beginning, you started with 10,000, and then at the end, DGRO is $23,711. S&P 500 is under that with $22,951, and the QQQ has $30,243. And something I wanted to point out here, when they hit their all-time highs on December 31st of 2021, DGRO was at 24,755, S&P was at 26,445, and the QQQ was at 40,815. And then today, almost a year later, DGRO has only dropped about $1,000. The S&P has dropped a little over $3,000, and the QQQ has dropped $10,000. So it really shows the resilience of DGRO as well as the S&P 500. And since DGRO was founded, it's actually outperforming the S&P 500. And now let's go down to the income. As you can see in the blue, we have DGRO with $246. This is 2015. S&P 500 with 210, and the QQQ with $107. And the dividends grow over time. And I'm going to show you 2021. DGRO is at 471. The S&P 500 is at 327, and the QQQ is at $174. So even if the S&P 500 starts to outperform DGRO, I don't expect it to outperform it that much. And just considering that DGRO consistently grows their dividend by that amazing 11.4%, if I had to choose between DGRO and the S&P 500, for me, I would choose DGRO.